Hi, everyone, and thank you for joining. We're going to let everyone continue to log on and get started in just a couple of minutes. Thank you. All right, let's go ahead and get started. Hi, everyone. Thank you for joining today's webinar, Top State and Local Tax Challenges for the Healthcare Industry. Today's program will be presented by Jim Bartek, Partner and SALT Practice Leader, Jason Rosenberg, SALT Principal, and Bonnie Susmano, SALT Senior Manager. Before we begin, I have a few notes. Today's materials can be found in the toolbar on the right of your screen and will be distributed to you after the program. Also, at the bottom of the toolbar, you will see questions box. Feel free to send us your questions during the presentation. We will do our best to address them during the session or at the end. There will be 4 polling questions throughout the program. To qualify for CPE credit, you must participate in each poll. CPE certificates will be emailed to you within a few weeks. And finally, once the webinar is over, there will be a pop-up asking you to complete a survey of today's webinar. Please take a moment to complete it. It is our way of being able to provide you with the best and most relevant programs possible. I'll now turn it over to Jim.
Thanks, Rachel. So hi, everyone. And again, today we're going to be talking about top state and local tax challenges for the healthcare industry. With more and more hospitals becoming for-profit operations, new physician practices popping up around the country, medical providers and vendors should consider their state and local tax liabilities, including both sales and use tax, income tax, and gross receipts taxes. So during this session, we'll touch on some of the hot topics we've seen while assisting our healthcare clients. So I'm Jim Bartek, state and local tax partner at Withum and practice leader. I've been working with state and local tax issues for clients in industries including healthcare for over 28 years, 22 in the Big Four at my prior firms. I've handled research, compliance, software systems, process, refund reviews, audit defense, and of course, ASC 450 issues. Now, also with me is Jason Rosenberg. He's a SALT principal with over 15 years experience assisting clients with SALT income tax issues at Withum and previously at the Big Four. Jason's also the chair of the New Jersey Society of CPAs State and Local Tax Interest Group and works closely with New Jersey and other states to address taxpayer concerns. And then lastly, Bonnie Susmano is a senior manager, formerly out of our New York office, now out of her home base of Atlanta. And Bonnie has tremendous amount of experience dealing with all issues related to sales and use tax. She's worked with Big Four and a few other firms and has worked with over 1,000 clients while here at Withum. So has a ton of experience working with healthcare providers and vendors serving the healthcare industry. Next slide, please. And this is just our disclaimer. And the next slide. So as part of the agenda, we do have a wide range of attendees, including healthcare providers, vendors, CPAs, and even some government officials. So during this session, we'll talk about sales tax implications of common healthcare services, sales purchases of products, services sold to healthcare providers. We'll touch on exemptions. We do see a lot of errors with exemptions, and sales by not-for-profit entities as well, because we do see errors with that as well. We'll also spend a few minutes on state audits. Then I'll turn it over to Jason, who'll speak about SALT PTET, which is pass-through entity taxes. He'll also speak about telehealth implications and then the effect of telecommuting and the mobile workforce on income taxes. We'll also touch on some SALT trends to keep an eye on. As Rachel mentioned, if you do have questions, please send them and we'll either attempt to answer them during the session or at the end of the session. If we don't have time at the end of the session, we will reach out to you separately after the session. Of course, feel free to contact us if you have any questions after the session. Our info is listed at the beginning of the deck and also at the end of the deck, and we're also on LinkedIn, so feel free to look us up there. Next slide, please. Now, keep in mind throughout the session that we're going to give you some general rules. However, it's important that you really understand the product services that is being provided and then research the specific states. I like to tell people that each state is different. It's like its own country. It has its own rules related to income tax, sales tax, and other taxes. So for sales tax purposes, which we're going to touch on first, each fact could change the taxability of the actual service. Now, the following services are generally not taxable in most states: medical services, dental services, physical therapy, nutritional, chiropractor, etc. But it's important to note that certain states do impose a tax on medical services. There are certain states that tax almost all services, like Hawaii or New Mexico, for example. There are also some states that actually, like a California, which could attempt to tax any tangible personal property that you are actually providing to a patient. For example, there was a California tax appeals case where they actually held that the true object of the patient's prenatal imaging was the images provided after the ultrasound service. So photos or CDs were provided, and that was the actual result, and not necessarily the service itself. So it was not a medical necessity. So again, you have to be careful if you're providing certain types of services with tangible personal property to your clients. Now, if you're a medical service provider and selling tangible personal property to your patients, you should understand the taxability of the items you're selling. So you may have to collect sales tax. For example, if you're a dermatologist selling creams or lotions, you would have to understand the taxability of those items in your state. As a general rule, in states that impose a sales tax, if you're selling tangible personal property, it's taxable unless there is an exemption. So for another example is a dentist selling toothbrushes or water picks or so forth. Most states would impose sales tax on these. However, if you're giving them away, you may have to pay sales tax to your vendor or accrue use tax on those items, unless it's an exempt entity, of course. So another example is a dentist sells mouthwash. This could be taxable. However, and Bonnie will cover this a little bit later, but if they sell a prescribed mouthwash, this could be exempt. So it's very important to understand your state's rules as you move along in the as you start selling different products and services to your clients. Now, services are generally different. So while tangible personal property is generally taxable, services are generally exempt unless specifically enumerated, with a few exceptions like Hawaii, New Mexico, and a few other states. So again, keep that in mind. You have to understand your state, and as I've mentioned before, each state has its own rules. Next slide, please. Now, while medical services are generally exempt, cosmetic procedures could be taxable in certain states. They do, again, they're improving appearance, not intended to treat an illness or disease. Of course, reconstructive surgery could be different. So at one time, if you're from New Jersey, you do remember that they did tax cosmetic services. They were changed in 2014. And the next slide. And but Connecticut does still impose a tax on cosmetic surgery, hair transplant, injections, hair removal, laser treatment of leg and veins, and cosmetic dentistry and so forth. Now keep in mind a nose job, for example, or to have a nose job in Connecticut to correct an appearance, it would be taxable. However, if I had a deviated septum, that could be exempt. So don't assume it's not taxable because it is a medical procedure. please do your research. Next slide, please. Now, telehealth services, we see this popping up all over the place. That's where a healthcare vendor will, the healthcare provider will provide a remote service, obviously through internet connect. Especially this came up during COVID a lot, where the providers were setting remote meetings with their patients and so forth. So doctor visits, remote patient monitoring. Now there's online education as well. So the issue here is with while the medical services may be non-taxable, the software, if it becomes software or information or data processing that the provider is buying, that could be considered taxable. Okay, so I know they pass through, some of the doctors pass through the cost to the patient and so forth. You have to be careful how you're doing that. If you're charging separately, is it considered a taxable event? Also, if you're purchasing it, you have to understand the taxability, because you want to make sure that if you're not being charged sales tax, you're accruing use tax on it, so you don't get hit during an audit. Now, they're obviously very helpful, not only during COVID, but you may have elderly or immobile patients. You might be in a rural area. It could help with behavioral treatments like anxiety, depression, and because it's convenient. So you may be able to increase your patients' visits. So there's obviously pros to having all this technology and so forth, but you have to really understand what you are providing. What are you buying and what are you providing to your patient? Now, other areas, of course, are where not only telehealth, but you have technology in general areas where people are incorporating some of the software technologies into wearable devices or wellness apps where you could be providing information. There's a lot of new technologies coming out there that we see throughout when we're doing a lot of our sales tax reviews and so forth. So while generally medical services are not taxable, the technology could be taxable in many states. So there's a lot of uncertainty there, especially once you have bundled services, which means you're selling something that is taxable with something that's non-taxable. Then we get into a lot of conversations on whether the true object is the non-taxable service or the taxable software. Okay, so with that being said, let's move to the next slide. And I'll pass that over to Bonnie.
Okay, just to chime in on what Jim was just talking about, as far as technology, telehealth, and different services provided by technology companies, it's definitely a hot area. I'd say at least 30% of the practice are technology companies because they're providing some sort of software, but the primary purpose or true object needs to be looked at. And what we're seeing on audits is that the states are becoming more and more aggressive in their positions. Massachusetts definitely likes finding software as a service and is not interested in the information or data that's being provided. They're very aggressive, as is New York State. So it's definitely something to keep in mind because we're seeing it with a lot of our clients, especially on audit. Now going over to sales tax with respect to sales and purchases of healthcare items, such as medication and supplies. Specifically, prescription drugs are generally not taxable in most states. For example, Connecticut provides an exemption for prescription drugs, including sales of syringes and needles, while New Jersey provides an exemption for prescription drugs that are for human use. And there are a lot of different statutes, depending upon the state, that indicate human use because most medications for animals, prescriptions for animals are not exempt. It really does depend upon the state, which is why it's important to do research in that area. In addition, certain states impose sales tax on prescription or over-the-counter drugs. Illinois, for example, prescription and non-prescription medicines for human use are taxed at a reduced rate of 1%, while Ohio only provides an exemption for drugs dispensed with a prescription. And you'll notice, depending upon the state and the statutes, it really, you have to look at the language, the statutory construction, because some of them are specific about that it has to be with a prescription. Over-the-counter or non-prescription are exempt if it's required to be labeled with drug facts panel in accordance with Federal Food and Drug Administration, overseeing that in Texas, for example. So each state really is unique in how they define their criteria. And Washington imposes a sales tax on over-the-counter drugs for human use to hospitals. As you can see, the states are really specific, some of them in their statutory construction. Notice that it's mainly the more aggressive states, New Jersey, Connecticut, Washington, New York. But we always like to say things in terms of generalities. Non-prescription medications are generally taxable in most states, but occasionally they can be tax exempt in Connecticut, Maryland, New York, PA, Texas, which is why, again, it's important to look specifically at each state and their rules. Next slide, please. Okay. In addition, as far as sales and purchases of vitamins, dietary supplements, this is where things can get really tricky, because depending upon the state and how it's characterized by that state, some states consider it a mineral, some say it's a vitamin, the way I think most of us think of it. Some say, depending upon what's in it, it can be a food. And just like when you're at the grocery store, looking at, ingredients and additives and sugar and carbs, you got to check the label. And that can really be the focus of when you're looking at something for a client, as far as whether it's taxable or not, because you have to get that nitty gritty and look at the label. Nutritional supplements and vitamins are considered food and therefore exempt from sales tax in Maryland, for example, because they specifically provided guidance in January 2020. And in Ohio imposes sales and use tax on dietary supplements because the state doesn't consider dietary supplements to be food. While vitamins and dietary supplements are not taxable in Pennsylvania because they qualify as medical supplies. So there are other states that generally exempt supplements and vitamins from sales tax, like Florida, Vermont, Wyoming, but again, it's always important to check the state. Next slide, please. Now, when looking at sales and purchases of medical devices, for example, we looked at prosthetic devices for New Jersey, and New Jersey does not impose sales tax on prosthetic devices, whether it's sold with or without a prescription. But New Jersey does define it as a replacement, corrective, or supportive device, including repair or replacement parts for the same worn on or in the body. And there's criteria, right? Artificially replace a missing portion of the body, prevent or correct a physical disability, or support a weak or disabled portion of the body. Again, important to look at statutory construction and notice that in this case, it's disjunctive with the or. So any one of these can meet the criteria. In Ohio, prosthetic devices sold without a prescription are taxable. So as you can see, again, the prescription comes into play depending upon the state. And then in Georgia, sales tax exemption on the sales or use of any durable medical equipment or prosthetic device sold or used pursuant to a prescription, and to the sale or use of all mobility enhancing equipment prescribed by a physician. Again, the prescription comes into play. Next slide, please.
And just one point that Bonnie, I just want to make is obviously each state is going to have their own rules on what qualifies and what doesn't. Like for example, and you're going to have some items such as like in New York, for example, arch supports, teeth, limbs, hydraulic patient lifts, prescription eyeglasses, pacemakers, stairway lifts, surgical implants are all exempt and so forth. Right. But again, you're going to have to understand, that some of those some items may not qualify for exemption as well. So since it is an exception, you've got to really make sure you understand the laws. A lot of states do have good guidance on that, but you do have to be careful.
Agreed. As far as, you know, looking at other medical devices, like in New Jersey, they provide the exemption for durable medical equipment for home use by a human, and again, define the standards that need to be looked at, whether it can withstand repeated use, primarily and customarily used to serve a medical purpose, generally not useful to a person in the absence of illness or injury, and conjunctive is not worn in or on the body. So all the criteria needs to be met. And to Jim's point, the states are getting better and better about clearly outlining the criteria.
Yeah, and also on this one, for example, note New Jersey's exemptions for home use. So that's important. Whereas I was helping a hospital, a for-profit hospital with an audit, and they were buying items that were clearly durable medical equipment, but it wasn't for home use. It was for use at the hospital. So therefore, it did not qualify. Yep. And you know, again, items such as a surgical knife could be taxable. You know, so you gotta be really watch what you're buying and make sure you have a process to accrue use tax if you're not being charged sales tax.
Right. Okay, next slide, please. Sales or purchases of medical devices. We were looking in Massachusetts as an example, durable medical equipment. You know, according to general laws of Massachusetts, they provided a technical information release showing that there's an exemption for certain equipment if, again, prescribed by a physician, and discussed, you know, kidney dialysis machines, enteral and parental feeding, some feeding devices, suction machines, ultrasonic nebulizers, you know, incubators, heart pacemakers, breast prosthesis, patient lifts, things that would be actually prescribed. So again, it comes down to a prescription in Massachusetts, whereas in, you know, in certain other states, it's statutory construction and not always about a prescription, such as like Pennsylvania sales or sales at retail or use of it remains subject to tax for durable medical equipment. So, for example, like prosthetic devices and are exempt and exempt therapeutic devices. So again, it goes back to statutory construction in the state. Next slide, please. Certain states also have been providing guidance with respect to mobility enhancing equipment. California does with respect to sales to health facilities, sales or leases that are continuing sales and purchases of a wheelchair, crutch, cane, walkers to hospitals and other facilities are considered subject to sales tax because they're deemed to be the end user using those items in the provision of their services. And so such sales or leases aren't considered sold to an individual for the individual's personal use as directed by a physician, right? It's a different use. But when the wheelchairs or crutches, canes, walkers are ordered by a healthcare facility on behalf of a specific patient as directed by a doctor, the items can be considered purchased by an individual for his or her personal use and therefore may qualify for exemption in California. So it really depends upon who the user of what's being purchased and how it's being ordered, whether it's the hospital or whether it's being ordered for a specific patient by a physician by like prescription. Whereas in New York, drugs and medicines intended for the use internally or externally in the cure or treatment, prevention of an illness in a human being, medical equipment and supplies that are required for such use to correct or alleviate that physical incapacity are considered exempt when consumed by humans for the preservation of their health. So again, it goes back to statutory construction and guidance provided by the states. Next slide, please.
Okay, on to our first polling question. Are sales of medical devices subject to sales tax?
Okay, you don't have to be right or wrong.
Leave it up for about 20 more seconds. I'll go ahead and close it out. And here are the results.
Okay, and that is correct. So 81% of you were correct. So it really depends on the respective state law. So again, yeses and nos could be correct depending on your state and what medical device you are saying you're in. Okay, so let's move on to the next slide. So we're going to touch sales tax exemptions. So next slide here. Yeah, so one thing I want to point out for not-for-profit entities, right? So it's very important that each entity, if you have multiple entities in the organization, that each entity applies for the exemption. So state rules are going to be different, and for the certificate expiration differs as well. So for example, the New Jersey certificate does not expire, of course, unless there's a change in entity. However, Pennsylvania certificate does expire and needs to be renewed periodically. So we do find that a number of our clients do not update their certificates periodically, and therefore, in theory, they are not subject they do have to pay tax on the items they're purchasing. So again, keep that in mind. Look at your state laws because you don't want to let that certificate expire. So again, non-compliance can lead to exposure. So if you don't have that certificate, like I said, you technically do have to pay sales tax to your vendors. And if you let it lapse and they don't charge you the tax, you could be audited. And it happens a lot in Pennsylvania, where companies get or not-for-profits are on the hook for the sales tax not paid to the vendor. One other point I want to mention here is savings opportunities. They could exist if the sales tax is paid by the exempt entity for an exempt purchase. We do find this a lot on telecom bills, or for example, where people forget to give the certificate over to the vendor. Next slide, please. In New York, it's very important that if you're a not-for-profit organization, you do not automatically qualify for sales tax exemption. You do have to apply for it, the exemption with New York, and there's a form number on here, the 119.2, along with your IRS determination letter. Now, it may be limited to 501c3s. Each state, you do have to look at that, by the way. For example, if you're a 501c6, you may not qualify for that exemption. And of course, as I've mentioned previously, any units of an organization must file their own application for exempt status. We've come across a couple of clients that set up a for-profit entity, for example. Definitely need to understand that purchases for that entity don't qualify for the exemption for the not-for-profit entity. Next slide, please. And once they receive the certificate, of course, all purchases are going to be exempt as long as they're used for the not-for-profit purpose. And the next slide. Now, here's a scenario that I did want to mention because we do find errors on audit with this as well. Is New York publishes this right in 843, where they basically give two examples. One where they're buying the treasurer is buying office furniture and he's using a company credit card or a not-for-profit organization's credit card. Now, they may purchase that furniture exempt Now, if they buy the same thing with their own credit card, they do not qualify for the exemption. The reason is they're not using the funds of the exempt organization. Next slide, please. So again, like I mentioned before, certain states may impose sales tax on not-for-profits like California and North Carolina. So it's important that you understand the type of entity, the type of property, and the other factors that could be outlined by the states on not-for-profit entities. Next slide. So as I mentioned, California hospitals and other medical service facilities are deemed her service enterprise and considered the consumer of the tangible personal property. So again, they're going to be paying the tax when they buy it. Now, obviously you're not going to pay tax on exempt sales like medicine or certain food products. Next slide. I'll hand it over to Bonnie.
Okay. Moving on now to sales tax, sales by not-for-profit entities. Next slide, please. First, I thought it was important that we discuss Nexus because I'm finding more and more that clients haven't heard of it or aren't aware of it, but Nexus is basically the minimal connection or contact with the state that's sufficient to establish that the state impose a tax on them. So, and certain considerations have to be thought of with respect to sales tax, whether it's necessary to register, collect, and remit within a state, which has been giving clients, perplexing a lot of my clients lately. So as far as nexus or that minimum connection, the terms that are generally heard are physical nexus, such as an employee in a state, independent contractor, a sales representative going into a state, depending upon the number of times, right? Inventory stored in a state, even having a server in a state. Whereas economic nexus refers to a certain dollar threshold of sales or gross sales into a state rather, and or number of transactions, depending upon the state. These thresholds and or number of transactions varies. So what happened? What led to these changes with that minimum connection? Well, physical nexus got you that connection into a state, but the economic nexus, that really threw the whole playing field, right? Because in Wayfair in June 2018, the Supreme Court ruled, right? They ruled in favor of South Dakota by, some look at it as reversed. I looked at it like they expanded, right? Now it's even easier to tax a company, not just by physical, but now, hey, you make enough sales into my state, you have nexus. Why? Because I want to level the playing field between our brick and mortar stores in state with those that are remote. Why should remote sellers have an unfair advantage and not have to collect and remit sales tax? So that case came out in 2018, and the states obviously were quickly jumping on the bandwagon and coming up with their own economic nexus thresholds. All states have enacted economic nexus standards, including DC, but remember, 5 states do not have sales tax. Next slide, please. So going back, because I tend to always like looking at what went on historically case-wise, and in Quill, right? In Quill, everything was about physical presence. So in 1992, less than 2% of Americans even had access to the internet, right? Hard to imagine, but today now the number is about 90% or more. In 1992, mail order sales in the US totaled 180 billion. I don't know, I hope I'm not dating myself. Anybody remember those, Land's End and LL Bean catalogs, right? Mail order. But in 2021, e-commerce retail sales alone, right? Internet sales estimated at 870 billion, which was an increase of 14.2% from 2020 and 50.45% from 2019. In 2021, e-commerce represented 13.2% of retail sales in the US. In 1992, states were losing about 694 million and 3 billion per year as a result of the physical presence rule. And the estimated range in 2018 was between 8 billion to 33 billion. So the change in the law to economic nexus really changed the whole landscape of sales tax. Next slide, please. So again, at a glance, all the states at this point have enacted economic nexus standards, Missouri being the last one, which was enacted for January 1st, 2023 this year. They were the last to adopt, but they did jump on the bandwagon with retailers selling at least 100,000 into the state in the previous 12-month period must collect sales tax from Missouri purchasers. Again, 5 nomad states do not have sales tax, and although a taxpayer's revenue stream may not be taxable in their home state, their sales into other states may be subject to sales tax. And we're also finding more and more that clients don't realize that. They're thinking because it might not be taxable in their state that there are no issues for them in other states. That is not the case, depending upon the state. Next slide, please. Now, sales by non-for-profit healthcare entities, things that have to be considered are supplies and shared services, software sales, bundled services, bookstore sales. The reason these sales have to be considered is a lot of times we work with non-for-profits that think because they're a non-for-profit that what they're selling isn't necessarily taxable. And more and more, there are non-for-profits that will have a discrete business line or service going on. And because it's revenue generating and not necessarily for the intention or purpose of what that non-for-profit is about, it can be taxable. So it really depends upon the state and their rules regarding sales by non-for-profit entities. And again, what's being sold and what the purpose is for in creating and having those sales. Next slide, please. So for sales by non-for-profit healthcare entities in New York, again, generally sales by a non-for-profit shop or store are taxable unless the item is specifically tax exempt, like food. And another exemption applies, if it's an exempt entity. It really just depends because, I've had clients like hospitals that have, those gift shops when you go to the hospital to visit people. Well, I can assure you, if you're going in Pennsylvania, the rules really vary on what's being sold in those stores as far as taxability, because PA likes to make it tricky, right? You would think it wouldn't be taxable because you're in the hospital, but guess what? If it's a sugary snack and it's a gift shop in a hospital in Pennsylvania, it's taxable. So it really depends upon the state, the type of non-for-profit entity, and what the purpose and how it's being sold. Going back to New York, other potential taxable sales in New York, you have to look at leases and rentals of tangible personal property, sales of utility services, parking, and hotel occupancy. Depending upon, the entity and the sale, it can be taxable. Next slide.
Yeah, and Bonnie, I'll handle this one. So, and if you are selling services or products across state lines, we do have a calculator. It's online. You can take a look at that, or of course you can always call us and we can talk through the nexus, how you determine where you have nexus, where you have obligations, and so forth. So, but again, that is a big issue for a lot of our healthcare clients. They don't realize they're selling into other states, and they do have nexus. So, next slide, please.
On to our second polling question. Do not-for-profit entities need to collect sales tax? Reminder to get your votes in to get CPE credit. We'll leave it up for about 30 more seconds.
is a bit of a trick question here. But again, you don't have to be right. You just have to answer it to get your CPE credit.
All right, I'm going to go ahead and close it out.
Okay, so again, there are a couple answers that were both the last two could have been correct, right? Yes, if selling taxable products serves a for-profit entity. Actually, yes, but the word only disqualifies the bookstore, because again, you could be selling, something else for that matter, which could be a taxable service or product, and it could be taxable. So next slide, please. So next slide, we're going to talk briefly about state tax audits, and I'm going to hand it over to Jason. But throughout my 30 years, I've dealt with my share of audits around the country, and no doubt some states and audits are more difficult than others. But if you're not prepared, all states can be difficult. Next slide. Now, here are some common issues for healthcare clients we've seen. Of course, management fees. If you have shared service centers where you have a shared service center for a not-for-profit entity that's servicing a for-profit entity in your location. We even have a particular client that has set up a shared service center who's going to be selling this to other potential hospitals and so forth, which of course could be a taxable service, or certain items could be taxable in that scenario. COVID equipment supplies, again, they weren't necessarily exempt in a lot of states. Durable goods, items for resale. Again, these are all particular issues we see under audit. Let's go to the next slide, please. Use of existing technology amongst entities. I just mentioned that. Again, you're selling it to for-profit entity. So you really got to understand what was purchased. For example, was it software? Was it information service? Was it data processing? Were you selling equipment, or were they leasing equipment? And then you also have to understand where it's being used. For example, if you have New York and New Jersey, you might have different rules there. And then which entity is using it? Is it the for-profit or the not-for-profit entity? And next slide. Again, auditors are back in action. We've seen extreme pressure to close cases, and states are sending questionnaires, especially if you have in this remote work environment. If you have payroll in one particular state, they may be sending you notices for some other states, some other state taxes. Okay, and then of course there's definitely increased enforcement in a lot of different states. The auditors are out there on the prowl. They're coming in. They want to be looking at sales tax, income tax, and so forth. So again, it's going to be quick because we are bumping up, and I want to send it over to Jason now.
Great, thanks, Jim, and thanks, Bonnie. So what we're going to do here is talk about the pass-through anti-tax elections, or also known as the SALT workarounds. Since the enactment of the TCJA, which had limited the amount of state and local taxes that can be deducted for federal purposes, since that went into effect in 2018, we've seen a multitude of states have enacted a pass-through anti-tax election, also referred to as a PTET election. Or some people, again, refer to it as SALT workarounds. As many of you know, this limitation's capped SALT deduction to $10,000. This cap applies to property taxes, sales tax, and state income tax. And as a result, PTET elections are especially valuable to businesses within the healthcare industry, as many healthcare businesses are structured as flow-through entities. So today we're just going to have a really brief refresher on this continuous evolving landscape of SALT PTET elections. So as we look at this slide, in terms of where we are now, when it comes to PTET elections, right, the first thing we need to keep in mind is the interplay between federal and state tax. First, the entire origin of PTET is due to the fact that the TCJA put in place a $10,000 limitation, right, for federal tax purposes in deducting state and local tax. As a result of the SALT limitation, right, some high tax states felt that they were disproportionately affected. As before the SALT cap limitation went into place, right, high earners in these states were essentially being subsidized by the federal government as they'd be able to recoup some of these state taxes as a deduction on the federal return. So immediately after the SALT limitation was put in place, high tax states started to attempt exploring different workarounds in order to maintain this deduction for their residents. The first thing we need to remember, again, is essentially states are enacting a workaround to the SALT limitation at the federal level. So that's, individuals can preserve their state deductions, right? So what we saw in the early days after this limitation went into effect were some states enacting workarounds such as charitable deduction, or there was something called a payroll tax workaround. In addition to, some states exploring the use of a PTT election as a workaround. There was no sure, at that time, right after the enactment of the TCJA, there was no sure confirmation on what would actually work in the view of the IRS and, potential legal litigation and so on. So in April 8 of 2018, Connecticut became the first state that enacted PTT workaround. However, one unique feature of its PTT when it was first enacted was that it was mandatory, not elective, which in all states that enacted PTT after Connecticut offered its the PTT as an election. There were a number of issues with the other workarounds, the charitable deduction workaround, the payroll tax workaround, and the IRS had issued regulations back in 2018, and it limited the applicability of those workarounds. However, later, in a couple of years, fast forward, November 2020, the IRS issues what we call Notice 2020-75, and that essentially green-lighted the use of PTT elections. And it's ignited the trend of PTTs being offered, in the states from coast to coast that we see today. In respect to the states that do impose a personal income tax, right? Pretty much almost every state now offers a PTT election. Now, there's a few holdouts. That's Pennsylvania, Maine, Vermont. We've seen some proposals in those states, but essentially at this point, almost every state does have a PTT workaround. And that really stems from the November 2020 notice that the IRS issued. And, as we look at, let's fast forward to the next slide here. In terms of the mechanics, right? How does this work? How does the PTT work, right? So the way it works is, number one, right, business decides to make the election. That's the easy part. And then number two, right, traditionally speaking, flow-through entities are subject to tax at the entity level by, making a PTT election. They're going to be subject to this entity-level tax, right? So to reiterate, right, flow-through entities, the income is going to pass through to the ultimate owners, but by making this election, you're going to be taxed. The business is going to be taxed at the entity level. Since the SALT limitation only applies to individuals, right, the business entity can deduct the state taxes at the business entity level, reducing business taxable income that's passed the owners through a K-1. So essentially, the business owners are going to get a K-1 with less income on it because they've made that election, took the deduction at the business level, and so for federal purposes, there's going to be less income to report, and therefore they're getting the deduction. It's a backdoor way of preserving that deduction. Now, since the flow-through entity's income still flows to the individual owner, right, the state tax will apply at the individual level. So in order to mitigate double state taxation, a state's going to either provide what we call a PTT credit or PTT exclusion. So the whole point of this is supposed to be revenue neutral for state purposes, okay? So that's, at the end of the day, we're getting a deduction for federal purposes that comes through at the business level. For state purposes, everything's revenue neutral. That's conceptually speaking. And so there's no change for state and local tax other than the fact that the states come up with a nifty solution to preserve a deduction that had existed prior to federal legislation that went into effect in 2018. So it gets a little complex in the mechanics, but essentially that's what's happening here. Now, if we look at the next slide, we'll see, right after it was enacted, went into effect a few months after, you could see very few states had a PTT. But if we go fast forward now to today, let's go to the next slide here. you'll see that map is filled in. So, over a course of a few years, we've seen exponentially, right, states enacting PTTs. If we move forward to the, perfect. In terms of benefits, right? I mean, we all know the main purpose is to circumvent the federal limitation. That is the benefit. And states are going to either, in order to mitigate double state taxation, as I mentioned, right, you're going to get either an exclusion or you're going to get a credit. And that's essentially what's happening here. If we go to the next slide. So every state's unique. Every state's PTT election differs in eligibility, how you apply the rules, in terms of unique sourcing rules or due dates, or do you still apply like non-resident withholding rules if you make the election? There's so many considerations, right? Not going to get into all the nuances, but just be aware, right? Every state's going to have different rules and how you apply, who's eligible, how you get the credit, how you do the calculations, and so on and so on. We could have a whole hour session just on that. But the bottom line is, there's a common denominator, right? And the common denominator is to preserve a federal deduction. How you get there, right? There's going to be differences along the way. Looking at the next slide. So in terms of risks, and we're not going to go through all the risks today, but I think the key takeaway, right, that everyone should walk away is that it's important to model PTT elections, right? Every company, every business is going to have their own facts and circumstances. So in order to evaluate, does it make sense to elect, and what states does it make sense to elect for, and other decision, making tools, right? You're going to want to model everything out, look at the different scenarios, and then be able to exercise on those, based on those models and those different scenarios. So you're going to want to model everything out. That's going to be super important. Moving on.
Well, on to our third polling question. Which of the following states does not have a PTET? About 20 more seconds. All right, I'm going to close it out. And here are the results real quick.
Perfect, yes. So states that don't have a personal income tax like Florida won't offer a PTT, but states that do, like New York, California, and Georgia, are states that are candidates for offering this workaround, and therefore that is correct. Florida does not have a PTT. Moving on here. So now we're going to quickly talk about telehealth and those related implications. So flipping over to the next slide. Perfect. So I'm sure, there's no surprise to everyone on, with everybody today with this webinar that, right, telehealth is becoming more and more of the new norm as more and more medical professionals provide medical services remotely, such as doctors, nurses, providing clinical care to patients that may be at home or in another remote location. There's a host of state tax issues that surface that we wouldn't ordinarily see. First, when a medical provider hires a telehealth medical professional, right, that's located in another state, as Bonnie, discussed a little bit earlier today, right, that's going to cause nexus. Whenever you have an employee or oftentimes independent contractor in another state, you're going to have a filing obligation as a result of that nexus. Now, next, right, revenue of the medical service provider needs to be divvied up or sourced amongst the states in which the business has nexus. So how do we source these revenues generated from telehealth services? Well, traditionally speaking, when clinical care is provided as an in-person service, right, it's easy to identify how to source those receipts. But when a medical provider's, providing those services on, to a patient remotely, there's a lot of complexity that comes into place, and states might either source based on where the patient is or where the medical provider is, right? There's a whole host of unique issues that need to be considered. Moving on to the next slide. And most states use a three-factor, some states use a combination of these three factors, either payroll, sales, or property in calculating apportionment. Many states have adopted in the recent years a single sales factor only, not relying on payroll or property, making the sales factor all that much more important in considering how to source revenue. Looking at the next slide. And this map just shows, market-based sourcing, right? That would be looking where, for example, when it comes to telehealth or telemedicine, where the patient is, opposed to where the clinical provider might be. And so you can see in year 2000, only a handful of states at most imposed market-based sourcing. And then if we look at the next slide, we can see like 20 years later, right, that map has completely flipped. So, there's been quite the evolution with market-based sourcing. Looking at the next slide. So we're going to quickly flip into telecommuting and the mobile workforce and talk about some of the key developments that are going on. If we look at the next slide here. So with telecommuting, whenever you're hiring a remote employee, you're going to have a host of issues, and we've spoken about Nexus, so we're not going to focus on that, right? And we've spoken about income tax apportionment. Now we want to focus on payroll withholding. So if we look at the next slide, and these are some of the factors or issues when you're hiring an employee that's remote. When we're looking at apportionment, right, what are the effects? Well, the payroll factor might be affected because now you got payroll in a different state than where the medical provider might be based. The property factor is going to be affected if the state uses a property factor because that medical provider probably uses computers or other type of equipment. And then, of course, from a sales factor perspective, states that use what we call cost performance, that sources revenue based on where the medical provider is based, is also going to be impacted. If we flip forward to the next slide, traditionally, most states, in terms of withholding on payroll tax, is going to be based on where the employee performs services. However, some states use what we call convenience of employer rule, like New York, which is very notable in applying. And I think we see an example of a definition on the next slide, I believe, if we flip forward. And convenience of employer rule basically says is if an employee is assigned to an office, right, even though they might be working remotely, their taxes might still be subject to withholding in the state where the employer is based. So, for example, if you have hire a remote employee in Florida, that remote employee in Florida reports to an office, a facility, a premise located in New York, and New York is one of the more notable states that apply convenience of employer rule. Well, even though that employee might work only 2 days a month in New York and the rest of the year down in Florida, New York would impose tax on 100% of that employee's wages. And so, that employee who works remotely and then lives remotely in Florida, which is, of course, a state that doesn't impose personal income tax, well, now that employee is paying tax in New York on 100% of their wages because of the convenience of employer rule. If we fast forward, and right before we get to the polling question, I just want to mention, so New Jersey last month enacted their own convenience of employer rule. What's unique, it's a little bit more limited in scope than New York because it only applies to residents of states that also apply convenience of employer rules. So it's retaliatory in nature, but it is out there, just so you're aware. State has released guidance, but hopefully more guidance is forthcoming. Now let's go ahead with the polling question.
Fourth and final polling question. Which taxes could be triggered by telecommuting? Reminder to get your votes in. We're almost out of time, so leave it open for about 20 more seconds. All right, I'm going to close it out.
It looks like most of the audience got it right. Again, it's generally could be all of the above, depending on the state you're in. Obviously, if you're in Florida, maybe payroll doesn't apply. So good job. And next slide, please, Rachel. Okay, so, and next slide. So basically, we're going to go through real quickly current SALT trends. So there's a lot of broadening of nexus standards, both on the income tax side and as you saw from Bonnie on the sales tax side. We do see rate changes, corporate and individuals across the country that could be increasing or decreasing, depending on the state's budget scenario. Expansion of the tax base, such as trying to encompass some foreign income or into the tax base, exporting the tax burden. Like again, those are taxes that you're trying to tax F-state companies and so forth. And of course, unclaimed property and excise tax on gas and cannabis and so forth, and nicotine. Next slide, please. And again, unclaimed property, Delaware just did send out a new set of notices. So keep that in mind. If you do get a notice, just make sure you talk to somebody who's knowledgeable on unclaimed property. So the sales tax expansion is big. Again, the states are trying to expand the definition of, as well as their laws on digital goods, servicing and advertising taxes and so forth. Again, a lot of different states are doing studies on the effects of the digital economy. New Jersey is one of those, for example. And how does it affect when items are now being from services that were traditionally non-taxable, or should they be taxable as a digital good and so forth. You also have gross receipts taxes, Oregon, the Ohio CAT taxes and so forth. A lot of states going to that direction. And then of course, increased audits. We see a lot of increased audits out there, as we discussed before. Next slide, please. One thing I would encourage you to do is sign up, but we do have a dash of salt. It goes out weekly, and we send it right to your email box. Here's a link. You can sign up. Again, these are free, and you can certainly always contact us with any further questions. Next slide. So thank you again for joining us here. If you do have any questions or further questions, feel free to give us a call. Our contact information is here, and or to shoot us an email, and we'll get back to you as soon as possible. Thank you again.
Thanks, everyone. And for those who submitted questions during the session, we will answer those questions via email afterwards. Thank you.